Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and the finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist of the Australian Financial Review.
And we are the Money Café. Now, James, you had a couple of pieces this week about the market. On Tuesday, you talked about the bond markets rumbling, bond vigilantes.
Yes.
And this morning, you said that the cash levels of fund managers is very low. What is the cash level and what does it mean?
Well, cash levels fall when fund managers invest more in the market. So Bank of America has a fund manager survey they've been doing for 25 odd years. And when the cash level that fundies are holding gets below 4%, it's generally a good signal to sell. That's been triggered since 2011. It's been triggered 11 times, I think, that sell signal. And on average, the market falls 2% in the next 4 weeks. So the cash level now is 3.9%. So,
and why? What's the significance of 4%? Just happens to be that number.
That's just over time. That's proven to be the number where it shows that fund manager risk taking or risk appetite, I should say, has got to a sort of quite bullish toppy level.
Right.
So it's interesting. The Bank of America guys, I spoke to one of them from Paris, a guy called Elias Gallou, very interesting fella, and he was saying it's probably not going to lead to a bunch of selling this time because while fundies' risk appetite has shot up after the Liberation Day, what we haven't seen is a whole really big rush to equities, particularly. So positioning in equities, whether they're global equities or US equities, is still relatively light from fund managers. So they're in the market, but they're not necessarily in stocks, which is the riskiest trade.
What are they in?
They're shorting the US dollar. That's the most crowded trade at the moment. They're in gold. That's the second most crowded trade at the moment. So they're playing around, I guess, in those more macro positions, which are essentially bets on Donald Trump chaos.
Yeah, maybe gold. Maybe the gold holding should be added to the cash.
Yeah, that's true. Or even sort of seen as a proxy for the US dollar. If you don't like dollars, you go into gold. So, there's a lot going on from a macro perspective. Just on the bond market, that we've seen really across the world this week: Japan, Germany, US, UK, France. The long end of the bond curve, so long-term debt, 30-year debt, the yields have gone up on that all around the world, really, which is the bond market saying, hang on, we don't love the fact that governments are going to just keep spending and keep spending and keep spending, and they're reacting to that and saying, well, if you want to keep spending, we're going to demand a better return for the money that we lend to you.
I was amused to note, James, that as soon as you wrote that on Tuesday, bond yields started to fall. So you picked the top.
Yeah, that's true. Well, it's interesting though, Alan, because you've got that concern there about government debt, but in America you've got this extra concern about what Trump does to Jerome Powell, the Fed chairman, and the theory there is if Trump fires Jerome Powell, which is sort of looking increasingly likely, then bond yields are going to shoot up further because people are going to lose confidence in the Fed's independence. Trump would like the Fed to cut rates, but that's not what inflation says should be done. And so, again, bond investors will say, no, we don't like what's going on here. We need an even bigger premium.
So Trump said last night, told reporters last night that he's not going to fire Jerome Powell, unless there's fraud. And there might be fraud, he said. But, I reckon, I don't know. When the boss says, we're not going to fire you, I reckon that's when you're in real trouble.
Yeah, it's like when the footy club chairman says the coach's position is safe.
Exactly.
I think, though, Alan, I don't think this... I'm with Victor Schvetz here. I don't think this matters. Trump's already busted the Fed's independence. Powell's there, okay, but he's not going to be there for beyond May next year. We know the next person's going to be a Trump hack. So I think the Fed's independence has already been eroded. I mean, how is the next Fed chairman and the governors, they're going to be thinking of two things when they make their decisions, the political implications and the monetary policy implications. I think Trump's already got what he wants. And it's interesting what you said there about the CEO. All these agencies have been known as independent bodies, the frank and fearless type thing. But Trump is a business person. He thinks he's the CEO and all the business units should answer to him. And that's what he's doing. Now, rightly or wrongly, you know what? I would say wrongly because that independence is important. But Trump's very consistent on this. He's actually, there's so much noise around Trump, but if you sort of step back from it, Schwetz makes this point that it's actually pretty consistent. He wants tariffs. We're getting tariffs. Now, there's a lot of crap around them, of course, but hey, the tariffs at the start of the year were about 2%. By the end of the year, they're going to be somewhere between 15 and 20%. Now, everybody thinks Trump's chickened out, but actually he's increased the level of tariffs somewhere between 7-fold and 10-fold. That's going to happen.
Yeah, sure. No, you're absolutely right. Tariffs are what's happening, and I think it's all about that. He's just trying to raise revenue.
Yeah.
I mean, I don't think it's a trade. I don't think it's a trade story at all. I think it's just a GST.
I think there is a sort of manufacturing type story in there. I think in Washington there is a sense that the fact that the US can't make a warship. I'm picking something a little bit at random, but not completely. The fact that the US can't make a warship without lots of Chinese rare earths and Chinese technology and a bit of Chinese steel and copper, or copper refined in China, that does worry America. But that's not going to be reversed quickly, if at all. So you're right; it really comes back to revenue.
Yeah, I think so. I mean, I don't think the tariffs. I think they know that the tariffs aren't going to just result in a sudden blossoming of American manufacturing. They have to do much more than that. In fact, they're in the process of winding back the Biden Inflation Reduction Act, which actually encouraged manufacturing. So,
indeed.
Speaking of CEOs, you kind of like the new CEO at Rio Tinto, don't you?
Yeah, well, I think he's a really sort of...
What's his name?
His name's Simon Trott, and he's replacing Jakob Stalsholm. I think there's
Who got fired, right? Didn't he get fired?
Well, that's a good question, Alan. Stalsholm was brought in after the Rio had that disaster around blowing up a sacred indigenous site called Juukan Gorge back in about 2020. Everything went to pot at Rio. They brought in Stalsholm as a sort of stabilizer, firefighter. He's done a pretty good job of both of those things, I guess. But now they're looking towards a new era of growth. He'd been there about 5 years. It was always clear he was sort of a transitionary CEO. Now, did he want to stay on a bit longer? I think probably. Has the chairman, Dominic Barton, decided he needs to move on? Probably. But anyway, the result is we get this guy, Simon Trott. And he's been running Rio's iron ore business, running it very successfully. It was in a pretty bad state 5 years ago. He's seen as having turned it around. He's an Aussie, West Australian guy from the country. His family ran a big sheep farm over there. It's a great story, Alan, about his parents back in I guess it would have been the 80s, spent a bunch of money putting air conditioning in the shearing shed. Now, that you might be thinking, where's this going? But the point for Trott was it was a big expense, didn't need to be done, but his parents had sort of seen that, providing something for the workers would engender loyalty and better productivity and make the whole thing work better. And so Trott sort of said that's a lesson that stuck with him. There's a way to lead. He's a thoughtful guy. Very sort of considered, not at all brash and sort of table thumping type of guy.
He's going to put some air conditioning in the crib rooms in the mines, I guess.
Well, I think there's plenty of air conditioning in the crib rooms, but I think I think he's going to come in and look to cut costs, actually. So maybe it won't be that worker friendly, but for the workers who remain, it'll be pretty friendly. But he's been tasked with slimming the place down.
If you were a fund manager, would you be investing in Rio now?
It's a tough one. I think this guy is going to run the place harder. So, yeah, I mean, I think I don't want to give, stock tips, Alan, but I think this guy's been brought in with the specific mission of driving efficiency, unlocking value through cost cutting, slimming the place down, simplifying it. So that's going to be attractive to a lot of investors. And the other thing, I guess, Alan, is if you're looking for an alternative to very expensive CBA stock, maybe that story would appeal to you.
Yeah, well, speaking of CBA and CEOs, what's going on with the CEO of NAB? Andrew, your colleagues at the Fin Review had an interesting story on Tuesday.
Yeah, well,
saying the fund managers are getting stuck into the chairman over Andrew Irvine's drinking or something.
Well, yeah. Look, I think drinking is a big call. I think it's more about Irvine. Andrew Irvine is the CEO of NAB. Used to be the head of business banking at NAB. Business banking is a relationship game. So you do a lot of socialising. There's a concern in the market that Irvine hasn't made that transition from his old job as a relationship banker to his new job as a CEO quite in the way that the market would like to see. That's been raised with the chairman. But it's, to me, and I've sort of written this today, it's, I guess, a bit of a tale of broader unhappiness or unease with NAB's direction under Irvine. They lost their CFO, a guy called Nathan Goonan, the chief financial officer, suddenly quit and joined Westpac earlier this year, which is very unusual.
Yep. In fact, you point out the last time that happened was when Michael Ulmer jumped from CBA to NAB, and that was years and years ago.
20 years ago, that's right. So there's disquiet about that. NAB's obviously Australia's biggest business bank. That's their heartland, but business banking margins are good compared to the crappy margins in mortgages. And so every other bank in Australia is now trying to get in the business, into business banking as well. So there's a lot of competitive pressure on NAB all of a sudden. So there's general sort of unease, I guess, about NAB's positioning and its sort of strategy at the moment. I think that's we're seeing that sort of come out a little bit.
Okay, right. And just back on Rio, I mean, and the iron ore companies, they were all over in Shanghai the other day having a press conference with Anthony Albanese.
How'd you think that went?
Well, it was after what they called a steel carbonisation roundtable with Chinese steel mills, and all the Chinese steel mills were there, along with the four big iron ore exporters. Rio, BHP, Fortescue and Hancock, Gina Reinhardt's business, and they were all there. And they had a press conference afterwards with the four iron ore people standing beside Anthony Albanese, and there was one question about steel carbonisation. There was the questions were all the usual political stuff.
Yeah.
So, and I just think that, I'm writing about this at the moment. I think they're missing out. I think the real story about this elbow trip to China is steel carbonisation, decarbonisation. I mean, and green iron, because that's what he's over there trying to get going. And I mean, sure, it's good. It's good that he's meeting Xi Jinping and pressing the flesh and everything. But really, it's all about trying to, in a sense, rescue Australia's iron ore business, because. And in particular the coal business and Australia's minerals exporting business in general, because as China and the rest of the world decarbonises, coal's out and hydrogen is in. So we've got to get into that game.
Yeah, and I mean, the other complicating factor for those who are not deep in the iron ore game is the Chinese steel complex, the Chinese steel industry is gradually going to move over the next, well, probably 4 decades towards these electric arc furnaces, which are a cleaner way of creating steel. But the Pilbara iron ore that is so important to everything that happens in Australia isn't exactly compatible with those electric arc furnaces. So Andrew Twiggy Forrest is running around saying, "Wake up, guys! There's a problem here. The Chinese might not favour Pilbara iron ore as they have for the last 3 decades. We need to have a solution." His solution is to produce green iron. So green iron is, refined iron ore that's refined by using renewable energy.
They use hydrogen. So the way they get iron is iron ore from Pilbara or anywhere is just iron or ferrous oxide. So it's the iron combined with oxygen, and the purpose of blast furnaces is to remove the oxygen from the iron ore, and you end up with iron, which is just ferrous. And the way they get the oxygen off at the moment is that they mix it with coal, which is carbon, and the carbon mixes with the oxygen and forms carbon dioxide. But we're not going to be able to do that anymore. So what they are going to do is mix it with hydrogen, and the hydrogen mixes with the oxygen to form water, H2O, and that's the plan. And as you say, that it needs a different kind of blast furnace that because you can't use coal and you can't use hydrogen in the normal blast furnace. You've got to have another one, and but you need better iron ore because the process of using hydrogen is not hot enough to get rid of the impurities. There's other impurities apart from oxygen in Pilbara iron ore, and the thing about a blast furnace is it's really hot, and the rest of those impurities come off as well. But the hydrogen process isn't hot enough. And so they have to do another thing. And so what's happening is that the Australian Renewable Energy Agency, ARENA, is funding BHP, Rio, Mitsui, Woodside and BlueScope, and they're all cooperating in a project to come up with a way of getting rid of the gang, it's called, GANGU, getting rid of those impurities through another method, and they're working on that, and they reckon they'll do it fairly soon.
Yeah.
So that's kind of where it's all at. But Forrest is right. I mean, they've got to do something.
They do, but there is. We should say that there is disagreement, I would say, but with BHP and Rio, they acknowledge the problem, but they see it as a problem that will be sorted out over decades because these electric arc furnaces are not going to suddenly replace blast furnaces tomorrow. So, yeah, there needs to be a solution, but I think Forrest believes it's very urgent, and the other miners are more like, well, we've got time to adapt. We're working on it. We'll get there. Relax. Anyway, it's an interesting question, that's for sure.
It is. And just before we move on to questions, which we have to do, I just wanted to point out that Bitcoin has fallen back this week. It got to $122,000, new record high, and now it's gone back below 120 again. But at the same time, Ethereum, the second biggest cryptocurrency, has been rising, continued to rise. And I think the reason for that is that the new legislation in the US that is designed to regulate cryptocurrencies, called the Genius Act, which is I think they were talking about and working on last night. And also Europe is regulating and legislating to regulate these things as well. Is that these legislations are focused entirely on stable coins, which are mainly Tether and USDC, and these are cryptocurrencies that are linked to the US dollar.
Yeah.
And the thing about them, what that's resulting in is a lot of focus are coming on. Most of the focus now is moving on to stable coins rather than Bitcoin, and both Tether and USDC operate on the Ethereum blockchain, and so the view is starting to develop that Ethereum's future is absolutely rock solid because of the promotion, I guess you'd say, by governments of stable coins as a way of doing in remittances overseas. So what people are doing is using these stable coins to send money overseas. So instead of using the bank, using banks to transfer money overseas, which can cost 5% of the total and take a week. If you use Tether or USDC to do it, it costs just less than 1%, much less than 1%, and can be done instantly. So, and that's all happening on the Ethereum blockchain. So Ethereum looks like it's pretty solid.
Yeah, there you go. Well,
there you go.
There's an awful lot of action in crypto at the moment, so it's unstoppable.
Before we get on to questions, here's a quick word from our sponsor.
Looking for a smarter way to invest? InvestSMART makes it easy by doing the hard work for you. It offers low-cost, professionally managed portfolios made up of ETFs, carefully selected by a team of experts, giving hassle-free diversification. Right now, there's a special offer. Open and fund a new account in July 2025, and you'll get a $100 bonus to help kickstart your investing journey. With options ranging from conservative to high growth, plus specialty portfolios like international shares, there's something to suit every goal. Visit investsmart.com.au to learn more. Terms and conditions apply.
Righto. So just on questions, we got a few questions, or really comments, I guess, about my comments last week to Stephen, James, about
a few
golf courses. Yeah, I know.
Sally, Michael, Marianne, disappointed long-time listener. They're into you. Gosh.
I'm just kind of, I'm not seriously supposing that we're going to bulldoze all the golf courses, but I was just pointing out that there's a lot of land in the suburbs going to have to be found. And, I was talking about the fact that the guy, the deputy chair of the Australian Housing Supply and Affordability Council has worked out that we need 34 square kilometres of land in the suburbs of Australia every year, which is a lot of land, right? So, I said, we're going to have to, perhaps we're going to have to look at golf courses and parks. And anyway, so all these people have kind of written in saying, what are you doing? So Sally says, I felt quite uncomfortable listening to that. Forcibly acquiring private land. So that's the other thing that Marcus Spiller, the deputy chair of the Housing Supply and Affordability Council, says is maybe the government's going to have to look at a compulsory acquisition of housing to help developers put together decent-sized blocks, because the problem is developers have a lot of trouble putting together a decent block because, there are one or two holdouts. So he's saying maybe we're going to have to look at compulsory acquisition. And Sally says, really, come on about golf courses, Jesus. And then Michael says that's short-sighted. There'll never be enough housing. That's the nature of the beast. Why do universities get so much land? What about schools? Marianne says, I hesitated to send this feedback, but as a long-time Money Café listener, I was so upset by your discussion with Stephen Mayne about Melbourne's golf courses, I felt compelled to share my thoughts. Oh God!
Are you a golfer, Alan?
No, that's right. I think we should just don't worry about it.
Well, I am a golfer, so I'm going to say I'll stand up and say something for the golfers of the world. I'm a very bad golfer. My God, it's a frustrating game. But I think this comes back to the idea of that you said on the last time I was on the podcast. We have a supposed crisis here, but no one ever acts like it's really a crisis or wants to treat it like a crisis. We are going to need to think of some radical suggestions. I think we would be doing everything we can to preserve parks and golf courses and all sorts of green spaces. But do we need to think creatively about different ways to use them, or different ways we can free up land to help solve this housing crisis if it is indeed a crisis. I mean, we need to get a bit creative here.
I agree.
And there's I think I'm not sure. Having listened to the discussion last week, I'm not sure you were suggesting an immediate closure of all golf courses, but in other parts of the world there are radical suggestions being used. I mean, just to throw one example at you, Singapore has recently shut down its entire horse racing industry, Alan. Why? Because they're going to use the track for housing.
Yeah. No, that's the other thing is I should have mentioned when I wrote about this about the racetracks, which are used very, very sparingly.
Well, now you're really getting into one of my special subjects, Alan. So I'm with disappointed long-time listener now. But, I guess my point is we are seeing creative different solutions around the world. I think I don't think you'd disagree with any of the correspondence. So we don't want to have to do any of this, but like, what's the sacrifice? What's the solution? What's the middle ground going to be found?
Yeah, no, totally. That's right. I mean, there's plenty of other problems with it. I had a meeting the other day with someone who talked about the fact that a big part of the problem is that unionised construction is much more expensive than ununionised. I mean, there's an element in this of industrial relations because the chair of the Housing Supply and Affordability Council, Susan Lloyd-Hurwitz, did actually say that one of the problems we have is that the construction industry is both not as productive as it needs to be and too expensive.
Yeah.
And she called out industrial relations in that. Yeah. And unionised, the CFMEU comes in when you get into high rise. As soon as it gets above 2 or 3 stories, or when you're starting to use a crane, then the CFMEU has to get involved, and so that's when costs start to really rise.
Yeah, it's one of these things that we need to throw lots of different suggestions at. So we've got to keep talking about this stuff. All right, let's move on. Matilda says that she's her name's Matilda, yes, and she's 13. Her brothers, who are 15 and 17, are making loads of money on Polymarket on things like, will the US have a national Bitcoin reserve in 2025? It's currently returning 244%. Or will a video game called GTA 6 be released before the return of Jesus Christ? That's returning 16% when the game is due to be released next May. Her brothers say it's not gambling because they understand more about the events than they do about companies on the ASX, and there are no fees. Surely this is a better strategy than investing in a boring ETF. This is fascinating to me, Alan, I must say.
So have you looked at Polymarket?
Oh, I've looked at it around the time of, the elections. It was huge in the lead up to the US election particularly. But I must confess I didn't know these sort of niche markets were quite as niche as they appear to be.
So the current chance on Polymarket of Trump firing Jerome Powell by August the 31st is 18%.
Right.
And you can bet on that. And then you can bet on will the Epstein files be made public in 2025, 18% as well.
And can you, as well as betting on these outcomes, can you let other people bet on them as well? Is that how it works? Is it a dual-sided market?
Oh, yeah. Well, you can buy yes or no. I mean,
gotcha.
You can bet on either side that he will fire Powell by August 31 or he won't.
What interests me though is these kids are apparently making loads of money. I presume they're making loads of money on much shorter term markets because US will have a national Bitcoin reserve in 2025. That doesn't. You're not going to get paid out there till January 2026. I would imagine.
Yeah, I guess so. There are. There's another one here. What will be said during Netflix's second quarter earnings call?
Oh God, Jesus!
I mean, there's so many.
How does it stack up against a boring ETF? In Matilda's words, Alan.
Oh well. I mean, it's certainly not boring. I tell you what, it's just straight out gambling. It's like which fly's going to reach the top of the wall first.
Yeah.
So look, it's not my cup of tea, but maybe some people do it, and obviously Matilda's brothers are into it, and 15 and 17, and fair enough, off they go.
Yeah. Tell them to tread carefully, Matilda, very carefully.
Well, gambling's addictive. It can be really problematic.
I know, totally. And this is completely unregulated. Matilda's brothers couldn't legally go into a TAB and bet on a horse race or a football match, and yet here they are betting on garbage on Polymarket. Interesting, isn't it?
Stephen says, I wanted to get your thoughts on an idea regarding Australia's super system. What if people are allowed to opt out of compulsory super contributions once they've accumulated a certain super balance appropriate for their age? And he goes on, but I think that was interesting. And there used to be something called reasonable benefit limits, which were abolished in 2007 by the Howard government, just before they lost. Anyway, these RBLs were a sort of a compulsory opting out. You couldn't get tax concessions above a certain amount of benefit. But I thought it was interesting and not a bad idea really for Stephen to say we could have an optional one.
Is the other idea that you have a compulsory opt out called super caps?
Well, that's right. We've got what's the super cap now? Is it still 1.6 million?
Yeah, something like that. No, well, there's no cap on how much you can have in super, though. I think that's...
No, but there's just a cap on how much you can get tax concessions for.
Yeah.
But, yeah, look, I think there needs to be probably some kind of cap. I mean, everyone's screaming about Jim Chalmers increasing the tax on income on balances above 3 million. Which is kind of people like Jeff Wilson are carrying on as if it is a cap, but it's just a slight reduction or a reduction in the tax benefit. Yeah.
Will in Footscray says, according to the UNSW, climate change is forecast to slash global GDP by 40% in a 3-degree scenario, which Will says is likely, 3-degree warming scenario. Why hasn't that been priced in as an issue for investors? Is climate risk still too slow-moving for markets to care?
A quick, short answer is yes. Investors and fund managers don't know how to price for this because the 3%, the 3-degree scenario is so extreme and so disastrous. How do you invest for complete catastrophe? It's hard. It's impossible.
Yeah. And look, I guess markets struggle to see much past 12 months at the best of times, and this is a decades long scenario. But yeah, I guess you might see it priced in sector like insurance, but even then, it's hard to figure out exactly where how a share price should move because of that scenario. So I think Will's right. Most people just don't do it.
Demetrius says, big fan of the pod, although my question is not really a finance question. You've been heavily focused on AI and the future of work in the last few episodes. My question is, could we use AI to generate abundant websites and information sources with incorrect technical information, thereby preserving our usefulness in the workforce, at least in the short term?
I like the idea.
I think there's a bit of that going on already, Demetrius.
Yeah. I've been playing around with AI a little bit. I must admit, it's tempered my doom a little. It can get some really basic stuff wrong, like in a way that just sort of shakes my confidence in it, I must admit. Now, maybe you might say, well, it's not major stuff, and of course the human would have picked it up. But I sort of think, how good is this going to be? I know it's improving all the time, and it's as it's as bad as it's ever going to be today, and it's going to get a lot better. But yeah, it's an interesting one. The idea of incorrect information. We're seeing unions sort of say the ACTU suggestion is that workers should have a right to opt out of AI, which is I don't quite know how that's going to work, but. Yeah, it's very interesting. There's a great bit of work Goldman Sachs did in the US, sort of a bottom-up bit of research where they looked at every Fortune 500 company and tried to work out how much of the work inside those, or the cost inside those, is AI-ifiable, to use a term. They reckon it's about 14%. That's not that much. So
yeah, well, it's still
still a fair
it's a lot
bit,
more than zero. A lot more than zero.
That's true. Yeah.
Got time for a couple more, I guess.
Phil says, really liked your idea about reforms to the GST you've discussed previously. Can you discuss this tax reform idea? Abolishing franking credits and using the savings to reduce company tax. The idea is to shift support from a distortionary and narrowly targeted benefit, mostly helping retirees and SMSFs, to something broader that could boost investment, improve productivity, and make Australia more globally competitive. It might also make it fairer, since the lower company tax would benefit all businesses and workers, not just dividend investors. Of course, the downside is that it would hit retirees who've structured their income around franked dividends and reintroduces double taxation on domestic shareholders. Is it a kind of trade-off worth considering?
Yeah, well, the Labor Party got hammered in the 2019 election because they tried to abolish cash refunds from dividend franking credits.
Yeah.
I don't think anyone's going to touch it, really. But look, I mean, I think dividend franking is worth looking at. I think it's one of the reasons Australian companies don't reinvest in the business. I mean, I've got a chart on the ABC News. I recorded something yesterday for the ABC News to run over the weekend, and this was a chart from my friend Gerard Minack, which shows that 40 years ago, business investment was 12% of GDP. In the 1990s, it fell to 8% of GDP, and now it's 6% of GDP. So basically, business investment as a share of the economy has halved.
Yeah.
This is since dividend franking was introduced, and the companies are all under so much pressure to pay out maximum dividends, franked, that they haven't got enough money to reinvest in the business, and the result is declining productivity. Anyway.
Yeah, it would be a seriously big trade-off. I don't know if you saw, Alan, this week, CBA, Commonwealth Bank, put a big submission to the Productivity Inquiry, which is Productivity's Commission's 5-pillar review, which Jim Chalmers has asked them to do. They said, don't worry about company tax cuts, that they can't be a priority at the moment, but the caveat was that dividend imputation needed to stay. So it's a tough trade-off.
Ian from Bulgaria. Ian is in Bulgaria. Well, good for you, Ian. Alan, he says, as communists go, you're pretty ordinary. I don't know, that's a bit of a backhand.
I think the tongue may be in the cheek here.
Maybe, yeah. Have you called for the nationalisation of the childcare industry even once? Now, property. If those poor souls, the capitalists, can't make their 7 to 8% building, if the capitalists can't make their 7 or 8% building homes, then the government steps in and builds them and owns them, leases them, and enjoys the increase in value of them. Hopefully, lots of them. So many of them, property spivs start losing money. I don't know. I mean, look, yes, one of the problems with the housing in Australia is the governments have all withdrawn from public housing, building public housing, and they're trying to get it done by requiring, in return for some sort of discounts, they're trying to require 10% of new developments to be for affordable housing as a sort of replacement for public housing, or housing commission, as we used to call it. Which, I don't know. I don't think that's going to work. I don't think it's working. And I think that, but the trouble is that governments, we used to do public housing, lots of housing commission and public housing in the 50s and 60s. But what's happened is that the priorities for government spending have shifted, and so now we've got so much more welfare, pension money, NDIS, and these are all sort of soaking up the money that used to be spent on public housing.
Yeah. I'm going to jump now to Mitch Allen, who's got 2 questions for us. Have we considered the rise of house prices and the inflated share market could be due to the internet and influencers? Before the internet, you had to call up real estate agents or brokers to buy something. Nowadays, you can look online and buy shares at the click of a button. There's also apps that automatically transact on your behalf. That said, I notice a lot of influencers in the past 5 years spruiking investing, whether it be shares or investment properties. These wannabe financial experts have only experienced the good times of growth and not any real downtime. And the related question is, should we be using financial data from the past 5 years as anything credible? That is a really good question, that second one.
Yeah, why? Tell me.
Well, I mean, I think what Mitch is getting at is that we've seen the economy change so much by COVID, the COVID spending, the inflation burst that was related to the COVID spending. Is there anything normal in that last 5 years period? Have we found the sort of our way back to the 2019 normal? Should these 5 years really give us a great point of comparison to say the last 5 years compared to the previous 5 years? I think that's a really interesting question that lots of analysts would be thinking about.
Well, I suppose it comes down to the changes that have occurred since the pandemic, are they permanent or not?
Yeah, exactly.
Yeah.
I think that's a really interesting question.
There's the usual 3-word answer to that. Time will tell.
Yeah. And what about the first one, Alan? Do you think that the rise of house prices and inflated share market could be due to the internet and influencing?
Of course, to some extent. I mean, sure, there's all these influences, crikey.
Yeah, I'm going to say no to that. I think it's more related to the amount of money we've pumped into the economy and how.
Oh yeah, sure.
You know, that's what makes the means of people spending that money or investing that money might have changed, but I think it's more down to the flow of the money that's important.
Okay, final question from Jared. I've lived in Scotland for some time now, but I listen to the Money Café each week for my Australian financial lowdown. Thanks for your insight. So, g'day to you, Jared, in Scotland. I'm intrigued by Australia's market, which seems to be heading towards high concentration in oligopolies across many industries, particularly in the banking and superannuation sectors. CBA's market share and valuation caught my eye. It appears to be driven by Australia's narrowly self-invested obsession with leveraged property and mandatory superannuation, yes. On a side note, it wasn't until I moved away from Australia that I fully appreciated how unique its tax policies are. Negative gearing, franking credits, discounted capital gains, superannuation taxes, and the absence of inheritance tax are all fairly uncommon globally. Yet from Australia's perspective, these policies are sacred cows, untouchable. Yes, no, that's true, and we often lose that perspective. We kind of, in our little Australian bubble, we think all these things are just sacrosanct, and in fact, nobody else does them.
Well,
it's true.
And that's what I found really interesting about, I mentioned this CBA submission to the Productivity Commission's big 5-pillar review. That's what I found really interesting about that. It does, and the CEO, Matt Common, was heavily involved in putting this submission together, and it does go to some of these sacred cows. You know, he does suggest that we need to look at what is the appropriate level of consumption tax and wealth tax. He does say we need to try and figure out how to prioritise what are the priorities between company tax and encouraging investment through other tax incentives. And in there it makes the point that we have had moments in the past where the tax system has had to be reformed or rethought or reset to suit the changing needs of the economy. And I just thought that was a really interesting idea. And it goes to Jared's question, you know, are those policies that he's called sacred cows, are they so sacred that we can't even think about changing them? Or is this a bit of a moment that we need to grasp? I mean, the tenor, I'd encourage people to go and find the CBA submission and read it. It's a really good idea. You know, just run through of what's happening in Australian sort of society and business and what you need to think about. Everything from AI to energy. It's really interesting. But
I must say that it's a pretty difficult find, to be honest. You really got to really dig into the Productivity Commission's website.
Maybe there's a way for us to link to it. I don't know if you can do that through the show notes. But look, it's just what it says to me is that we're sort of at a bit of an inflection point, and we might need to use Jared's term to think about carving up some of these sacred cows or shaving a bit of their wall, or however you want to think about it, if we're going to sort of reset the economy for the next X decades.
Yeah, well, Jared's also talking about oligopolies, and it is often said that Australia is like Noah's Ark, where there's two of everything.
Yeah. And perhaps it's ironic that it's one of those oligopolies making these suggestions. But it's interesting, yeah.
Yes. No, I must say, I think the banking oligopoly is pretty competitive with each other. I mean, they're not, they do actually compete.
Yeah. I'm sure we'll get some disagreement on that, but I agree. It's pretty intense. Could it be intenser? Of course, but yeah, it's interesting.
Thanks, everyone, for listening to today's episode of Money Cafe. It's been great. As usual, I'll be back next week with Stephen Main, so send in your questions and we'll answer them together by emailing the moneycafe@eurekareport.com.au. We'll answer as many as we can get to, at least. Until then, I'm Alan Kohler, founder of Eureka Report, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
Bye-bye.